Welcome back. We're finally doing Berkshire Hathaway. This company, anybody who asked me about a stock market crash the last 2 years or something and wanted to move all their money to cash, what I would tell them is just buy Berkshire, right? Because you're staying in the market and then you're aligning yourself with management who's a pro at handling stock market crashes, right? I mean, literally. So the market's been down and even Berkshire's been down from its recent highs. So what I wanted to do was go over 20 years of their financial data and come up with what we think is a fair value for the company and decide if we should buy it right now. Before I start though, I want to say happy Mother's Day to any mothers watching, though I will say that's probably pretty unlikely because only 1.1% of my viewers are female, right? 1.1%. So if you're part of the 1%, congrats on being part of the 1%. And if you're a mother, happy Mother's Day. Also, if you're part of the 99% males that watch the video, call your mom, tell her happy Mother's Day. All right, let's get started. So this is the Berkshire Hathaway website. I love it. It's just so freaking simple, easy to understand. I mean, like it's awesome. It's funny, but it's awesome at the same time because like it's very what you see is what you get, and there's no there's no ads, there's no flashy stuff. Yeah, it's awesome. Okay, so here is their letters to the shareholders, and you can see they got them going all the way back to 1977. So what I wanted to do is point out a few things from 3 different years. The first one we're going to look at is 2014. And the reason, and let me Control F, Vice Chairman, is that I want to talk about this letter that Charlie wrote. Where is it? Okay. So this is actually where our quote up top of the video comes from. This is an amazing thing to read if you are going to be a Berkshire Hathaway investor. I think Charlie does a great, I don't want to say post-mortem because that sounds morbid, but he tries to figure out why the Berkshire system works so well and predict whether the good results would continue if Buffett were soon to depart, right? Is it just Warren Buffett or has he built something that's going to last? It's a great letter. I'm not going to go through it. It's long, but it's definitely worth the read, okay? I just wanted to point that out. Now let's move to 2019. So the reason we're doing the 2019 shareholder letter is because I want to talk about 2 things. One, this GAAP rule. So there's a new GAAP rule. GAAP is generally accepted accounting principles, practices, whatever. It's how the businesses have to report their financial results. So now if you read up here, you see that there's, a new GAAP rule imposed in 2018 that requires a company holding equity securities to include in its earnings the net change in unrealized gains. I tell you what, man, they were laying the groundwork then to start trying to push to tax unrealized gains. 2018 is when it started, okay? But yeah. So anyway, what's that going to do? It's going to produce huge fluctuations in earnings in Berkshire, and that's what they talked about. They say that this rule's super silly. They said it before it went into effect, and yeah, he says, meanwhile, in what we call the real world, okay? Anyway, I wanted to show you that. And then there's a little bit I wanted to get here about repurchase philosophies. So if you just Control F, repurchases. Okay, so this is pretty interesting because we're going to use this later on. In past reports, they've discussed both the sense and nonsense of stock repurchases. So here's their thinking boiled down. They will buy back shares only if they believe it's selling for less than it's worth, and the company, upon completing the repurchase, is left with ample cash. He goes on to say, and other shareholder letters touch on this more, it has to be a conservatively calculated intrinsic value. It can't be, he's not going to buy $1 for 95 cents. That's not enough of a margin of safety, if you will, for the stock repurchase. It's going to be at what they think is a conservative value for the company. So really, it's probably worth more than what they're buying it for, right? One more thing about repurchases, and that's going to be from the 2012 shareholder letter. And what I want to Control F here is 120%. So why this number is important is because this is what they said. They were authorized by the board to buy back shares as long as the stock price was less than 120% of book value. So I thought this was super interesting because it really kind of gives you a number of like what they think is a conservative estimation of fair value for the stock, right? 120% of book value, all right? So anyway, we're going to use that later as well. All right, so let's look at the stock price real quick, and then we're going to jump into those 20 years of financial data. So this is Berkshire over the last year, and you can see they really went through a stagnation period. This is, and you're going to see this where they bought, I say stagnation, I mean, this was what, like 2 quarters? Yeah, I mean, this is where they bought out a lot of shares. Then we had a big rise as, some of the other high growth funds and stuff were crashing. People were running back to Buffett. And then, we've fallen back down a little bit. So the question is, let's see, we're down about 11% from this peak. Is it still a good time to buy? That's what we're going to find out. All right. Let's look at the financials. We're going to start with the income statement, but we're not going to do that much in the income statement, and I'll tell you why. All right. So here's our income statement, and this is just all we're going to look at is pre-tax income. And the reason is I wanted to literally illustrate why this gap rule was so freaking stupid. Look at these consistent earnings before. Okay. So consistent, growing, and it wasn't counting their investment gains, right? Because it would only count the realized gains. So, but look at this. Then just all of a sudden, it's just all over the place. Okay. Stupid rule change. We're not going to look at pre-tax income to judge this company. That'd be crazy. What we're going to do instead is focus mostly on the balance sheet, and then I'm going to get a little bit from the cash flow statement, but really mostly the balance sheet. All right, so let's move that way. First up is total assets, and one thing to note here is that they have about $1 trillion of assets. What I wanted to do with that, though, is look at their tangible assets. What are their total tangible assets? So this is going to be all their assets minus goodwill and minus intangible assets. And you can see it's close to $900 billion. So, they probably have 1 trillion minus 900 or 890, let's say. They probably have close to $110 billion of goodwill and intangible assets. But if you think about it, it's actually a pretty low percentage of their total assets. So it's really only like 11%, 11%. That's really interesting because what you see in a lot of companies, especially big conglomerates that are, eating up a lot of other companies, is that they'll pay up for all these acquisitions. They'll pay way over book value. They'll have a ton of goodwill on their balance sheet, and it'll be terrible. What this tells me is that even though Berkshire's doing all these acquisitions and has done all these acquisitions, they're usually paying not too high over book value, which means they're probably getting a deal in all the scenarios. So really interesting. Like to see that. All right, let's go to total equity. This is going to be the most important thing we look at for this company, right? And I've talked about this with Tencent before, another conglomerate, but really you got so much going on with these companies. You have so many subsidiaries, so many different income streams. So, why try to complicate it and try to value each segment and try to do all this? All you really need to look at is the total net worth of the company. The assets minus liabilities. Now, I know that the book value is not always representative of intrinsic value because, like, for example, you could depreciate an asset all the way to zero, but it's still worth something, or you could have assets that you have booked at a certain value that are worth a lot less. I know it's not a precise measurement, but I think it gives a really good ballpark, and it's just so much easier to judge based on this alone, right? So anyway, look at this growth. This is exactly what we want to see. I always complain about companies in my screening processes that don't have high equity growth because I'm like, what's going on? Is the company winning or losing? If you're making money and you're not paying out dividends, why is the equity not growing? Okay, so this is what you want to see, just so that you know. If you see this pattern here in a company, equity growth, that's a good sign. All right, so what we're going to do, well, first let me write down what it is. The most recent one was $517 billion. So I'm going to put that over here in the outline section because we're going to use that later, $517 billion. Next, I want to get a growth rate. And the way I'm going to do this is I'm going to look at the growth rate for the last 20 years, the last 10 years, and then the last 5 years, okay? So what I'm going to do first is the last 20 years. So what's their average growth rate? And the way that you do that is you say they're 517 now. So up here in the calculator, 517 divided by what were they 20 years ago. And you can see back here, my first data point is March, first quarter 2002. So exactly 20 years ago. So divide that by, what was this, 62 billion. So 517 divided by 62. So they went up 8 times in book value in equity in 20 years. And I raised that to the 1 over 20. And that gives me an annualized growth rate of 11.187%. So 11%. All right. So 11% growth over 20-year period. That's pretty impressive. Next up, we're going to look at the 10-year growth. Okay. So 517 divided by, what was it in March 2012? March 2012 was $180 billion. So 517 divided by 180. And I raised that to the 1 over 10, right? Because it's 10 years. Again, 11% growth the last 10 years. Pretty consistent, right? And then finally, we're going to do the last 5 years. So that would be March 2017. So 296. So I do 517 divided by 296. And I raise that to the 1/5 because it's 5 years. I get 11.8% growth. So actually a little bit higher, but still super consistent, right? Really, I just wanted to point out that consistency. I mean, that's awesome. Okay, so I know I say past performance is not always indicative of future results, but whenever you've been doing the same exact thing for the last 20 years, the last 10 years, the last 5 years, I think it's a pretty reasonable assumption to think that that's going to continue for at least 5 to 10 years, right? Okay, so anyway, growth rate 11%. I wrote that down. Now let's go to total liabilities. And I'm just going to look at this briefly. The only reason is that I want to get a debt to equity ratio. So if you see here, their total liabilities are $450 billion, which is going to give us a debt to equity ratio less than 1, right? Because 450 divided by 517 is less than 1. That's incredible. Now let's look at all their debt to equity ratios for each quarter. And look at this. Wow. All right. So what's so impressive about this is that the company's growing. They're growing assets, they're growing equity, they continue to make acquisitions, and they're becoming less and less leveraged. It's awesome. I love seeing this. Look at it for the last 20 years. I mean, they went from a 1.6 debt to equity ratio, which would still be good, to under 1. All right. If a giant company like Berkshire can do it, I don't feel like I'm asking too much from other investments to have debt to equity ratios less than 1. Anyway, that is awesome. One might even call it sexy. I bet you weren't going to hear that word in the Berkshire valuation, right? Okay. Anyway, let's look at what's next. Treasury shares. So I want to see, are they buying back shares? Yeah. So treasury shares is how much the company's buying back. And you can see they went a long time without buying back shares, and then it looks like big uptick recently, and have just been continuously buying, except this most recent quarter. This most recent quarter, they really didn't spend that much on buybacks. So what I wanted to do was pull up the stock price again. So here's the stock price, and I want to look at it the last 2 years, because you can see they were buying back a lot of shares in this time frame right here. So it looks like most of their shares were being bought back. This is very inexact science, but that's investing, right? So they were buying back a lot between, let's say, $250 a share all the way probably to $320-ish, I would say that the first quarter of this year would be, let's see, it'd be January to March. So this time frame here, they were not buying back as many. So one can assume that as long as it was below 315, 320 was probably conservatively below fair value, and that recently, let's say 360, 350-ish, it's not as much. But that being said, there's all kind of reasons why they wouldn't have bought back either, because what happened during this time for period too is that other stocks went down. So maybe they just had other investments that they liked more than their own because the other stocks crashed. It doesn't mean that they thought Berkshire was overvalued at 350. It could just mean that they had better opportunities. That's all I'm trying to say. But anyway, what they're telling us for sure is that they think it's definitely undervalued, probably around 300 or lower. Okay, so maybe even 320. So let's just keep that in mind. Real quick, we're just going to go to the cash flow statement and round out our financials. So the only thing I wanted to look at here was free cash flow. Now, one thing that's interesting, and you should note this, is that this is probably just their operating businesses, right? Because free cash flow is cash from operations minus your capital expenditures. So nowhere in that calculation is investment income or something like that, especially unrealized gains, all right? So I think it's a good estimate of how their operating businesses are doing. And if you were breaking Berkshire up into segments and doing a different valuation than what we're doing, you probably would want to be looking at this. I mean, it's rising. That's good. I mean, that's really all we're going to look at. Okay, let's go to valuation. We've waited long enough for this. Okay, so this is going to be a similar way to valuing stocks that we did for Tencent. It's going to be very straightforward. I could have just done, like I said before, a black box formula where I put in one number and it spits out what I think is the answer. But I want to walk you through the process so that you can do this on your own and you can do this for any company, okay? So basically what we're going to do is predict what we think the future book value is going to be using what it is now and what we expect it to grow by, and then put a future price to book ratio on that. And then that gives us a future stock price target, what the stock price is going to be 5 or 10 years from now, and then discount that back at our required rate of return or opportunity cost. We're also going to look at it in an inverted way of thinking as well. Okay, so first off, present book value, we said they had $517 billion of equity. So 517 and then 9 zeros, 1, 2, 3, 1, 2, 3, 1, 2, 3. Then we're going to do a valuation, let's say for 10 years. Look, if you're buying Berkshire, you want to hold it for 10 years, okay? This is a buy and hold if there ever was one, all right? And then growth rate of 11%, right? Let's say they're just going to keep on doing what they're doing. All right, and now what is our future PB ratio? So what multiple do we think the market's going to value their book value at? They've said before they think 120% is conservatively calculated fair value. So I'm going to say 1.3. You could put 1.2 there, but I'm doing 1.3. All right, and so what that does is it predicts what the future market cap's going to be 10 years from now. We think it's going to be close to $2 trillion. And then basically it just divides that by the number of shares to get what the Class B shares will be worth. I did Class B just because I thought most people watching the videos are probably Class B shareholders like me. I mean, if you have enough to buy Class A shares, congratulations. So anyway, how I did this was I just did that market cap 1.9 trillion. So 1.9 trillion and then divided by 704, which is the current market cap. And then I multiplied by 318. And that's how I got that 850. I mean, Excel did a little bit different. I had some rounding stuff, but yeah, you can see that's about how it works. All right, so anyway, there's two ways I want to look at this. I want to show you the inverted way of thinking first in honor of Charlie Munger, right? Always invert. So the question you want to ask yourself is, if I'm bought right now at $318 a share and held and sold in 10 years for $864, what would my rate of return be on that investment? And is that a good investment? So to do that, you do 864 divided by 318, and then you raise that to 1/10. And you can see that you would get a 10.5% return on your money by buying it right now. Now, let me tell you, I think that is probably true. I think that if you bought now, you probably are looking at a 10.5% return on your money for 10 years. That's just my opinion. That's not advice or anything, but there was a point where I had 100% of my retirement account in Berkshire Hathaway. I can't do it now because I'm forced to buy like mutual funds through work. So I have to just find the lowest fee cost one possible. But anyway, that's a different story. All right, so discount rate. What is our required rate of return or opportunity cost? So what this is going to do is, so instead of inverting the thinking, it's going to say, if we want a 12% return on our money, what should we pay right now? So let's say a lot of people do 12%. So if you want 12% return on your money, you should pay $278 for Class B right now. Real quick though, let me show you this compared to that 120%, because remember, he said 120% is a conservative calculation of intrinsic value. So their equity is 517 times 120 is $620 billion of market cap. You divide by 704, multiply by 318, and yeah, look at that, 280. So this 12% return kind of matches up with their 120% of book value. I think if you were to get it at 280, that would definitely be well below fair value and with some margin of safety. You know, I know people are thinking, I always put 15% return on my discounts. I think that this company, I put 15% because it keeps a margin of safety. And I'm doing that whenever I'm buying like small individual stocks because I want to make sure that they're going to, well, like I said, I want to have a bigger margin of safety. I think for Berkshire, you're still fine to put 12%. Like I said before, though, I think this is a great investment at the current price. I think if you held it for 10 years, you're probably going to outperform almost every index fund, mutual fund. I think the only way you're really going to beat them is if you pick individual stocks in a concentrated portfolio, but that's difficult on its own. If you want to learn how to do that, if you want to learn how to value companies, how to learn a process that's going to get you better investment returns over the long run, check out my channel for more. I appreciate you watching. Please like and subscribe. I'll see you next time.